Okay, everyone, here is this week's look at the charts with Bill Smith. This is just a little piece of our live session today. Bill's going to look at the charts. I hope you enjoy.
I'm going to start. Yeah, we're going to start off taking a quick look at the charts, looking at kind of where we've come. So we looked at this last week, and we've sort of continued this little rally. And I'll show you what I see and what I think or what a lot of people look at. But none of us know where this market's going to go. So but I would say there's a lot of potential kind of bullishness right now for a couple of reasons. So one is, I mentioned last week we had this downward channel that was sort of being respected to a degree, and then we broke out of it here, and we had just broke out of it last week, which is kind of a bullish signal. Well, we've continued that rally in the last week, so you can see that kind of played out as we talked about. The next thing I think is interesting that has come into play is this, I mentioned this also last week, is the 200-day moving average. It's a little bit of a magnet. So now that we're there, I think the question is what happens? This tends to be an area that a lot of traders pay attention to. And so because of that, it may be just a self-fulfilling prophecy. It doesn't really matter why it is. It's just an area to pay attention to. And what you'll see is that the 200-day moving average is so common out there that it tends to act as a kind of a support and resistance level. And I can give you a couple examples of that in backwards history here. Let me get some more years on the screen here. So you'll see areas like this right here, where we came down to the 200-day and bounced and came down and bounced and came down and bounced and came down again and bounced and came down again and bounced. So it acted as sort of a support level here. It's not exact. No support level and resistance level is ever exact. You just have to look at it as sort of a zone, if you will. That's the kind of way I view it. If we look at a couple other areas, you see the same thing here and here, where it kind of acted. And what's interesting, you'll see, this is a good example. It works as resistance here, and it works as resistance again here, and then we come up to it. And once you punch through it, then you'll see it acts as support. And that's true of a lot of support and resistance levels. And it's just a phenomenon that's comes from the fact that at some point buyers decided this was a good price, and so they started buying at that price instead of selling at that price, which is what they were doing back here. And so then when it came back down to that price again, they started buying again, and when it came back down to that price again, they started buying again. So once buyers decide that a level is a good price, then when it gets there, they start buying. And this tends to be what a lot of institutional investors do. They have a target price either to sell or to buy. And so those target prices tend to be where a lot of our support and resistance levels get established. But this is a good example of, maybe how that plays out. And you'll see it almost everywhere where we cross the 200-day moving average. You see it back here. Where are we at now? We're back in 2020. I can go back a little further. You'll see it, playing out. This is all the way back in 2018, but you see it kind of playing out here. Same thing here. Once we push through it, it then becomes kind of resistance. And then once we push through it, it comes back down and becomes support again. So it's not a precise thing necessarily. It's, as I say, it's a zone. But when it happens, and you even see it this year, here where we kind of punch through it, and then we see resistance here we punch through it and it became support, and so on. So the reason I pay attention to it isn't so much because I'm looking to trade off of those levels. I think if you've been watching what I do, that I don't buy a bunch or sell a bunch when we hit these levels. It's more to pay attention to sort of the broad view of the market. And what I mean by that is when we're above the 200-day moving average, the market tends to be bullish, and when it's below, it tends to be bearish. Maybe that's obvious to you, but if you just look back here, you'll see that like from here, which is, over 2 years ago, we went above it and we pretty much stayed above it for 2 years. Same thing back here. And then when we're below it, bear markets don't tend to last as long as bull markets. That's just a historical fact. You can kind of research that and see. But when we go below it, I tend to get more cautious, but when we're above it, I'll tend to just play out my normal trading plan. So that's one reason to kind of pay attention to. That's the only main thing that I use it for. But I do pay attention when we get close, and we may, for example, we may bounce off of this. We may see a retracement. I don't think this necessarily means that the bear market's going to continue. I would say what we're more likely to see is if this goes down, we might see a retracement like this, and then then we go back up. Markets, as you know, don't go up or down in a straight line. We see that right here. We've got this, and then we have a bit of retracement, and then we go back up, and so on. And that's just the way markets move. So I wouldn't expect anything different. And this would be a logical place for that retracement, because we often do bounce off that area. And in fact, the way I have this drawn, which is, I promise you, quite by accident, I didn't plan it this way, but this area of resistance where I have this line, which you'll see if we go to the left, why it's kind of resistance. There was some resistance activity right here and also further back. But anyway, that might be another logical place for it to bounce. Again, I'm not trading off of those levels. I'm just paying attention to them because I may want to be a little more or less cautious with my deltas. But I will keep my deltas in the range. Like, for example, one of the ranges we talk about is keeping your deltas between 0 and 1. Well, if I have a big position, I have the ability to get very granular. I can get closer to 0 or closer to 1, depending on my market opinion. I'm not going to go to 5. I'm not going to go to negative 5. I'm just going to keep it within the range, which is always going to be relatively flat. Because again, you guys know we're making money off time decay, not anything else. So those are some of the key things I'm seeing in the market. I don't know where it's going to go. I'm going to follow my EWS signals. This has actually worked pretty nicely. You can see right here is where we got our first green bar of this last series, and we've had a nice little rally coming off of that. And that's not unusual. See similar kind of thing back here. This was a lot of sideways chop, but we didn't tank, and that's really what I'm concerned about. And what I watch for most is the red signals. The red ones are the ones I worry about. So there we are. I'll come back to our trade in a minute, and we do have a trade on that I tried to close out last week a couple different times, and it never got closed out. So I'm going to show you that. I will update you on our August trade.